Leverage. Friends, in leverage there are three types. One is operating leverage, two financial leverage, and three combined leverage. We have discussed quite a bit about leverage, that is using the debt funds and using the other funds, that is other than the owner's funds, to optimize the return for the companies. So there are three types of leverages and we are going to understand each and every one. For that, please take a look at this. From sales, if you remove cost, what you will get is known as profit. Now this cost can be divided into two. One is the variable cost, which will move along with sales, and the other one is fixed cost. So variable cost will move along with sales and fixed cost will remain independent of sales. So I have given you the breakup of cost into two. So we'll arrive at the profit by dividing the cost into two now. From sales, if you remove the variable cost, which is one component of the cost, what you will get is known as contribution. And from contribution, if you remove fixed cost, you will get profits. But again, I'm going to give you, there are two components in fixed cost. The first component is operating fixed cost, which are necessary for running the business. The other one is non-operating fixed cost. They are not necessary for running, but still we have to incur. Fine. Now we'll build these two type of fixed cost also into a profit computation. So we'll see how it works. From sales, if we remove variable cost, what we'll get is contribution. From contribution, if we remove fixed cost, we'll get profit. Now we have broken the fixed cost into two. One is operating fixed cost. So from contribution, if you remove operating fixed cost, what you will get is known as profit before interest and tax. And from this, if you remove the non-operating fixed cost, what you will get is known as profit before tax. So friends, understand, the presence of operating fixed cost would tell us what is known as operating leverage. So how this operating leverage is computed? It is nothing but establishing relationship between contribution and PBIT. Whereas contribution by PBIT would give us operating leverage, and the presence of non-operating fixed cost, which could be predominantly the borrowing cost, would talk about the financial leverage. And financial leverage is computed as PBIT divided by PBT. So in this way we have established relationship between the contribution, PBIT and PBT. If we establish relationship between contribution and PBT, we will get something called combined leverage, and it is calculated as contribution divided by PBT, that is profit before tax. So here we establish relationship between contribution and PBT. But why we should establish relationship between all these numbers and what do we infer from all this? We'll take an example, we'll take numbers so that we can understand with high level of clarity.